Did you know that the unemployment rate can predict an upcoming recession? Today, we'll explore how this economic indicator has historically signaled a downturn and what it means for the housing and stock markets. Finance first, freedom follows. Welcome back to Finc Freedom. Today, we're diving into a fascinating and somewhat alarming trend. Whenever the unemployment rate crosses above its 24-month moving average, it's often the first sign of economic trouble. This might sound like just another boring statistic, but trust me, it's a big deal. This crossover has historically marked the beginning of significant deterioration in the labor market and could mean that a recession is just around the corner. So, what does this mean for you? Well, let's break it down and see how it can impact the housing market, stock market, and your wallet. Ready? Let's go! Section 1. Historical data. Let's delve into the historical data. This crossover has been a reliable indicator of economic trouble. For instance, during past economic downturns, we saw this pattern emerge, leading to rising unemployment and a slowdown in economic activity. According to a study by the Federal Reserve Bank of San Francisco, the unemployment rate crossing above its 24-month moving average has preceded 8 out of the last 10 recessions. This shows a strong correlation between this indicator and economic downturns. Section 2. Recent statistics and projections. Recently, we've observed this crossover again. With unemployment ticking above its 24-month moving average, economists are sounding the alarm. But why does this matter so much? The U.S. Bureau of Labor Statistics reported that the unemployment rate recently increased from 3.5% to 4.2%, crossing above its 24-month moving average for the first time since the pandemic. This shift has raised concerns about potential economic instability. Economist Mohamed El-Arian noted, "When you see the unemployment rate crossing certain thresholds, it's not just a number. It's a sign of underlying stress in the economy that could lead to broader issues." This insight highlights the significance of this crossover. Section 3. Economic factors. Experts believe this trend is linked to broader economic factors. When unemployment rises, it often triggers a chain reaction. Reduced consumer spending, lower business investment, and eventually a full-blown recession. This isn't just theory, it's a pattern we've seen time and time again. Harvard economist Lawrence Summers has emphasized, rising unemployment is often a harbinger of reduced consumer confidence and spending, which can spiral into a recession if not addressed. This connection between unemployment and consumer behavior is crucial. Furthermore, historical data from the National Bureau of Economic Research indicates that periods of rising unemployment have consistently been followed by declines in GDP, underscoring the interconnected nature of these economic indicators. Section 4. Impact on the housing market. One of the first casualties of rising unemployment is the housing market. As job losses mount, foreclosure rates tend to increase. Homeowners struggling to make mortgage payments can no longer keep up, leading to a spike in foreclosures. This, in turn, can cause panic selling in the housing market. According to data from RealtyTrack, during the 2008 financial crisis, foreclosure filings spiked by 81% compared to the previous year, reaching 3.1 million. This led to significant declines in home prices, with the Case-Shiller Home Price Index showing a drop of nearly 20% from its peak in 2006 to its bottom in 2009. Alan Greenspan, former chairman of the Federal Reserve, once said, "The housing bubble fueled consumption, and its bursting will fuel a contraction." This highlights how interconnected the housing market is with broader economic trends. Section 5. Impact on the stock market. But the impact doesn't stop there. The stock market also feels the heat. Investors fearing an economic downturn begin to sell off their holdings, leading to sharp declines in stock prices. This panic selling can exacerbate the economic situation, creating a vicious cycle. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." During times of economic uncertainty, market sentiment can shift rapidly, leading to significant volatility. In the 2008 financial crisis, the S&P 500 lost nearly 57% of its value from its peak in October 2007 to its low in March 2009. This was driven by widespread panic selling as investors reacted to the worsening economic conditions. Section 6. Historical comparisons. Think back to the last financial crisis. News headlines were dominated by stories of rising unemployment, falling home prices, and plummeting stock markets. We could be on the verge of seeing a similar scenario unfold. History has a way of repeating itself, and being aware of these patterns can help us prepare for what might be coming. Former Federal Reserve Chair Ben Bernanke noted, "The financial crisis of 2008 and 2009 was a wake-up call for the world that financial markets and the broader economy are deeply interconnected." This reminds us how intertwined different economic sectors are, reinforcing the need for vigilance. Section 7. preparing for a recession. So what can you do to prepare? First, stay informed. Keep an eye on economic indicators like the unemployment rate and housing market trends. Knowledge is your first line of defense. Consider diversifying your investments. During times of economic uncertainty, spreading your investments across different asset classes can help mitigate risk. Focus on your personal finances. Build an emergency fund, reduce debt, and be mindful of your spending. These steps can help you weather the storm if a recession hits. Experts also suggest looking at your career plans. In a recession, job security becomes even more critical. Consider upskilling or exploring industries less affected by economic downturns. The signs are clear. A recession could be on the way, but with the right preparation, you can navigate these uncertain times. Keep working towards your financial goals and be kind to the others. Thanks for watching Finc Freedom. Don't forget to like, subscribe, and hit the bell icon for more insights into the world of finance. Stay tuned and stay informed.